Hey, welcome back to Know Before You Owe. Brian Parker and the Brian Parker Group. Today we're going to talk about buying investment property and you not having to show $1 of actual income that you bring in to do that. And you might ask, how am I going to do that? Well, I'm going to tell you right here. Give me 3-4 minutes of your time. We'll be good on it. Now, there is an official name for this program. I'm going to dumb it down and we're going to call it the Investor Cash Flow Loan. Sounds a lot more simple than DSCR, debt service coverage ratio. Like, what is that? Okay. It's an investor cash flow loan. And here's how it works. Your lender, we have to verify your assets to be able to buy the home. And that the assets is going to have to be at least 25% down payment. Okay. But then to buy the investment property, I don't need your job. I don't need your pay stubs, your W-2s. I don't need your blood type. What I do need is I need a contract that's on the home you want to buy. Probably before you write that contract, a detailed conversation with you and your real estate agent about once you buy that home, what will be the fair market rent, okay? And what would it potentially rent for? If an appraiser does an appraisal on the property and sees the fair market rents, how much those monthly rents would be on that specific property. Okay. So I'm going to give you just round numbers on this. Okay. Let's just say the purchase price of that home, it might be 200,000, 400,000, doesn't matter. But for the purposes of our demonstration and conversation here, we're going to say the mortgage payment, principal, interest, taxes, insurance, HOA dues if applicable, all total $1,000 a month. Now, why am I using $1,000 a month? Because that makes this math pretty easy, okay? When the appraiser does the appraisal on the property you're buying, he or she must state in the appraisal, in the rent analysis that we have to order as part of the appraisal, that the fair market rents would be at least 10% greater than $1,000 per month. So if the mortgage payment is PITI HOA is $1,000 a month, then as long as the appraiser says the fair market rent is $1,100 per month or greater, it qualifies. Okay. Yeah. Now the property still has to meet all the required, inspections and be in good shape and habitable or can't rent it and blah, 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 blah. But that's how it works. If the mortgage payment and HOA dues is $2,000 a month, then the fair market rent on that property in the appraisal must state it's $2,200 a month. And that's how it qualifies. There are also no restrictions on how many properties you own. So in a typical agency, Fannie Mae, Freddie Mac type program, where you're doing a standard qualifying income, W-2s, blah, 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 tax returns, they will only allow you to have so many mortgages on how many properties, where the investor cash flow loan does not care. Now, give it the what if. What if the fair market rents come in below that 10% threshold? Well, there is a solution, limited solution, but there is one there. And there is the DSCR no ratio program, which means it doesn't care what that differential might be. But however, two things will happen if we have to look at it as a no ratio loan. One, your down payment just went to 30%. Okay. So, and we'll prepare you for that up front. That's why it's important we have conversations with your realtor and so forth for writing a contract about what those fair market rents might be. So we can prepare you what your total housing expense must be on the home. 2, your interest rate just got a little higher. It's going to be a higher rate. Now, keep in mind on these programs, these are considered a non-qualified mortgage, a non-QM loan. So depending on what state you're in, most likely they come with a prepay. In some states, prepayment penalties aren't allowed. So you can do it without the prepayment penalty, but that will give you even a higher rate. And in some states, you can choose to do it with or without the prepayment penalty. And with the prepayment penalty, it can be 1 year, 2 years, or 3 years. Some of them even allow up to 5 years, which I would never recommend. I'm typically never going to recommend anything longer than probably a 2-year prepayment penalty if we need to look at that. Your rate's going to be better than if you had no prepayment penalty. So that is your investor cash flow loan. Call me if you have any questions. BrianParkerGroup.com. Glad you found this video helpful. I'm feeling a little nostalgic today. Can't you see it? I've just got this thing going about me right now. I'm like, it's getting close to the holidays. I'm like, ho, 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 and a bottle of rum. But you know, that's the reason pirates never ruled the world. It was the rum. Gosh, God bless you. We'll see you next time on Know Before You Go. Brian Parker and the Brian Parker Group. Have a good one.